Good morning and welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Here are the stories we're following today. Joining us now is Adam Turnquist. He is the chief technical strategist at LPL Financial. Adam, it's an important day, I think, for markets because the Fed delivered what many had been expecting, a quarter-point cut in the Fed funds rate. The outlook, though, seems less clear, particularly in the context of the presidential election results. How are you reading the landscape right now?
For today's price action and the meeting from the Fed, I think it was kind of a no news is good news backdrop for equity markets. That at least seemed to be the reaction. They delivered the 25 basis point rate cut as expected. Looks like we're still going to get another one for December. But to your point, a lot of ambiguity, I guess we'll call it, as we look ahead to next year. I was surprised by the tone that Chair Powell used today. He was almost bullish on growth when you look at some of the commentary he talked about, especially highlighting this backup in Treasury yields, pointing out the fact that that's largely driven by more growth than it is inflation expectations ramping up. So some pretty interesting takeaways, I think.
But I think on the inflation side, there seems to be a very big question mark on the horizon, particularly when you consider the fact that we could be looking at tariffs, which could have an inflationary impact, a wider budget deficit, which then probably would force yields higher as well. Are you convinced that inflation has kind of been effectively dealt with?
I don't think I could say convinced, especially when you start looking at the trends in break-even inflation rates. That's the market's expectation of future inflation, and whether that's 2 years, 5 years, 10 years out, those break-even rates are certainly moving higher. Now, is it out of control? No, I think the Fed can still manage it where rates are. It's just a matter of the growth outlook as well, and how much of that inflation is really just a byproduct of better than expected growth.
So based on what you know of the Trump economic plan right now, would you be betting on growth for 2025?
I would not be betting against it. We still have a long ways to go until we start to see policy get delivered. And what Congress looks like, there's still some ambiguity around that as well, with the House still being decided. But when you look at some of the measures of his policy, just the deregulation, the likely extension of the 2017 tax cuts, some of the potential tax exemptions in terms of whether that's Social Security, overtime pay, things like that, I think you can attribute that to better than expected growth. Of course, we also have to be cognizant of where rates are and how they could actually weigh on the growth outlook, with yields now hovering around 440, 450 earlier in today's session on the 10-year.
I'm curious to get your take on the equity market. In the Wednesday session, we had volume in the S&P as the benchmark set a record high. I think it was 90% above the average over the last month. Today, there was another all-time high for the S&P. Same is true where the NASDAQ composite was concerned. I think the Dow may have been flat on the day. How do you assess the price action in equity trading right now?
Party like it's 2016, at least for the last 2 days. We've had this reflation trade reignite, if you remember back then. Small caps rallying, yields moving higher, the dollar moving higher. Of course, what I'm hearing from our advisors is how sustainable is this move, especially when you look at small caps, some of the moves we witnessed there. We like more on the bank side of the small cap trade. That's really where the momentum is, and I think more of a beneficiary to this president-elect Trump policy, especially on the deregulation, antitrust, deal making, all good tailwinds for the banking space, not to mention a disinversion of the curve and that steepening effect that's playing out as well. But I think from now till year end, we could likely see a little bit of a dip, but seasonals do tell us to buy the dip. Pretty strong momentum coming into year end here.
Tighter regulation certainly has been one of the clouds overhanging the mega cap tech space. How are you with big cap tech?
Big cap tech seems to be back. If you look at the equal weight Magnificent Seven index, finally breaking out to new highs, it's been really dragging and lagging the broader market. And I think a lot of people are surprised by that when you look at the broader index level, and it has not kept up with the S&P. It has not made new highs in tandem. Starting to see some leadership reassert itself in that space. But again, it goes back to interest rates and how they're going to be able to digest a potentially higher interest rate backdrop.
I was looking at a note earlier in the week, may have been late last week, from the guys over at Citigroup talking about the possibility that if there were to have been, as it seems there may be, a Republican sweep, that there is a big question about corporate earnings going forward. And particularly if you were to see a lot of the price action that we have been seeing in the equity market, where there's been this huge rally, maybe you want to think about selling into some of the strength. Would you agree with that?
I think the market's broadening out for sure, and your portfolio should probably follow that with some of the concentration risk. We do see the broadening theme play out on the earnings front. When you look at this year's earnings and the contributions from those mega cap names, that percentage drastically drops next year as we start to get contributions from other sectors. So I think that's where you're going to see some momentum. You can see it already when you look at the financial sector in the S&P 500, the industrial sector. Those are the sectors that are starting to outperform, and those are not where you see the mega cap names. These are more cyclical oriented type of sectors tied to the economy. And I think that's a good sign for the overall sustainability of this bull market.
One of the things that we've been talking about lately, the proposed tariffs that the incoming Trump administration seems to be advocating for. How does that change your thinking about international markets?
I think when we look at international markets, especially on the tariffs, you have to talk about China. A lot going on there this week outside of the U.S. election and the impacts there, especially with their top legislative party meeting this week and hopefully delivering some details on stimulus. I think that could be maybe enough to offset some of those tariffs. And of course, we know the starting point and what President-elect Trump has talked about, 60% potentially on all imports from China. Likely that will come down, and we'll see how the negotiation goes. But certainly a risk, I think, in terms of the inflation backdrop as well, just on the broader tariff threat.
So some of his proposals on tax cuts have kind of provided a bit of a carrot for major corporations to begin reshoring operations in the United States, presumably, although many companies have already identified Mexico as kind of a safe harbor. How are you playing the reshoring trade?
We like the reshoring trade or nearshoring trade, depending on how you'd want to define it. That was one of our more positive views last year when we're looking at the market through the industrial sector and holding that overweight. They're a big beneficiary of that theme as some of these companies kind of repatriate their manufacturing and their assembly in the United States. Of course, some of that industrial theme also ties into AI. A lot of those industrial companies building out some of these data centers. So an added kicker for the industrials and some of those more, we'll call it the build out of these factories and data centers.
Some of that trade has involved utility companies that produce power. Is there still life in that trade right now, or is that pretty much faded?
We think there's still some life there. Of course, this higher rate backdrop putting some cold water on that rally, but likely overdue when you look at some of these utility names. They're trading almost like the NVIDIA momentum in some of them. But when you look at the overall electric demand forecast, especially driven by those data centers and what we have for supply, there's a big gap there, which you could talk about uranium mining in that space as a potential another derivative play in that space that also seems to be showing some pretty good momentum.
So do you expect the momentum that we have seen over the last 48 hours in the equity trade to continue through the end of the year? Will we have this kind of proverbial Santa Claus rally?
Not at this current rate of change. I think the honeymoon period will likely end here over the coming days, maybe the next week, as overbought conditions start to take effect and we get some profit-taking pressures. And I do think there will be a dip buying opportunity into some of these more overbought areas. But I think we do have the likelihood of finishing higher. I just don't think we're going to be in a linear fashion as we've been doing the last few sessions here.
Adam, thanks so much for joining us on the Daybreak Asia podcast. Adam Turnquist is the Chief Technical Strategist at LPL Financial. Joining us now is Nicola. She is Bloomberg MLIV strategist, joining us from Singapore. There's so much to talk about. There's the election and the Fed decision today, but I want to begin with the market's interpretation of the election results. How do you understand the price action and what it seems to be suggesting here?
Yeah, so far it looks like stocks are really happy with the prospects of the Trump administration, largely because of the fact that it will be favorable for corporates in terms of tax cuts,
Hmm.
deregulation, of course, that's always a big positive for markets. So stocks look relatively happy. It just seems that the bond side is going to be a bit shaky, and the outlook for bonds are a lot shakier because of the fact now that with the potential red wave, you're going to get tax cuts, you're going to get a much higher deficit, and that's going to weigh on bond investors.
You know, it's very interesting. Obviously, we had the Fed decision today with a 25 basis point rate cut. That was widely expected by the market. For Powell to say that the presidential election will have no effect on the Fed's decision making in the near term, okay, I understand that near term, but longer term, clearly, anything that comes out of the Trump administration as it's channeled through Congress will definitely challenge the Fed, don't you think?
Absolutely, and I think that's the emphasis on the near term that you mentioned is absolutely critical because of course not only does the Fed have to figure out what's happening with inflation, but of course what is the impact of fiscal policy? How does fiscal policy weigh on inflation? How is trade policy? The new Trump 2.0 is expected to um, increase tariffs across the board. What does that mean for inflation? So I think the outlook for the Fed actually becomes a little bit more muddied in the sense of it's not only about the labor market data and the inflation data that the Fed is worried about, it's going to be compounded by what's happening on the fiscal policy front. We've seen it with the BOE. The BOE likely taking a cautious approach because of expansionary fiscal policy, and it's going to be the same case for the Fed.
It's not just a matter of spending more, it's that you're going to have far less revenue if you push forward a lot of tax cuts and you're forced to put a lot more supply into the bond market. And it seems to me like the bond market is going to demand much higher yields under that scenario. It was kind of very interesting because you mentioned the term red wave and perhaps fewer guardrails for the new Trump administration. It seems like the bond market has the potential to be one of those guardrails. Wouldn't you agree with that?
To some degree, but I think at the same time, you're going to have a lot more volatility in the bond market because of because of the fears of bond investors. Again, as you mentioned, like who's going to absorb all this supply that's coming through, and if we have less revenue, there's a whole outlook for the bond market that is a lot more cloudy than it was, let's say, before the Trump administration or the elections. And so if we're looking at, what is the outlook over the next 12 months, I would probably highlight that the clearest one is more volatility in the bond markets.
So let's talk about what's happening in your neck of the woods. I know you're in Singapore, but I want to talk about the NPC's standing committee meeting that's been going on in Beijing over the course of the week. What do we know about what policymakers in China have been rolling out, and how has the market been responding?
Yeah, so far it has been that we've heard a lot of skepticism about what they've already rolled out. There's been a lack of details. That's been exceptionally disappointing. We not only heard it from the markets, but we heard it from the likes of the IMF. And even there was a lot of criticism at the IMF World Bank meetings of how China has handled this so far. So the market is expecting a lot more, not only a lot more in terms of fiscal policy, but a lot more in terms of details. So what are they going to do on the consumption side? How are they going to revive consumer demand? What are they going to do when it comes to the local government debt? And also, what happens to all this property supply and the property overhang? That still is the underlying issues that are stifling the growth in China. And so the market is looking for something bigger. I think to some degree there was a lot of talk about maybe they were waiting to see the outcome of the elections because of the potential ramifications on their economy with another Trump administration. So the main factor still comes down to the fact that they have to come out big and bold and show their resolve and show that this is a whatever it takes moment, like we saw in September with that coordinated action, but really follow it through.
Yeah, big unknown, I think, for the export side of the Chinese economy is the issue of tariffs. We can save that for another day, Mary. But talk to me about what you're seeing in the currency market. I thought that yesterday the PBOC set a much weaker reference rate for the yuan, largely because of the rally that we had, the powerful rally in the U.S. dollar, right?
Yeah, and that makes sense, right? And I think there's going to be a lot of volatility in the CNY, but we have to remember also the CNY matters so much for, let's say, Asian currencies and even the euro, because of their dependence on China for trade. So what happens in the CNY is just as important as, let's say, what happens in the dollar. So the stability is going to be absolutely critical for Asian currencies and even for the euro. But at the end of the day, the weakness in the currency is a positive for their economy in terms of helping with export growth, and we saw export growth come out quite strong in last month. So they want to keep that momentum because that is the silver lining that we're seeing so far in the economy when consumption just remains so incredibly weak.
So what have you been writing about today on the MLIV blog on the Bloomberg terminal?
Yeah, so a lot of it has been because of the focus has been on the NPC meeting. That's been one of the key things in terms of how does that turn sentiment around and the importance of them coming out with a bigger, bolder move to show that to really keep the momentum in Chinese stocks going. There's been a lot of speculation in terms of an optimism, and that optimism just really needs to be backed up. Another key thing that we've been looking at is just what's happening with the rest of Asia in terms of equities. So earnings revisions have come off across some of the big markets like Taiwan and India. And obviously that means, especially for the likes of Taiwan and India, where valuations were quite frothy, it just poses some headwinds for these markets.
Mary, it's always a pleasure. Thank you so much for making time to chat with us. Mary Nicola, Bloomberg MLIV strategist, joining us from Singapore on the Daybreak Asia podcast. This is Bloomberg Daybreak Asia, your morning brief on the stories making news from Hong Kong to Singapore and Wall Street. Look for us on your podcast feed every day on Apple, Spotify, and anywhere else you get your podcast. Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. Plus, listen coast to coast on the Bloomberg Business app, Sirius XM, the iHeartRadio app, and on Bloomberg.com. I'm Doug Krisner. Join us again tomorrow for all the news you need to start your day right here on Bloomberg Daybreak Asia.